Welcome to Money on Tap, your personal finance headquarters, where we bring out the professionals experiencing some fun in what we call three-dimensional investing, utilizing insurance, brokerage, and fee-based planning. We believe wise investing starts with a plan. Your investments may have merit, relevance to a time and place, but this all depends on you, your objectives, and your goals. My name is Seth Krussman, and I'm here with Ben Brayshaw and John Ryder. We're all planners and partners with Brayshaw Financial Group. Good morning, guys.
Good morning,
Good
Seth.
morning.
Are we hitting 70 degrees out there in your neck of the woods?
Thursday, yes.
Oh, we hit 90 this week out here, believe it or not. But, I think we deserve it because we've put up with a lot of lousy weather here for the last week. That is for sure. So
We've been having that since, I think, October here.
So you don't have this, Seth. I was just talking to a client that came in the other day. She had a few inches of snow, but up north, way up north, up in Mount Washington area, 2 feet of snow. 2 feet.
Mother's Day?
Yeah.
Wow.
Yeah, so
Wow.
You can be thankful you don't have that out there. It's tough out here, Seth, but we do it. We're tough people out here in New England.
Yes, you are. Yes, you are. And, John, we're glad you're listening to Money on Tap. And if you're looking to sit down with an advisor and start making some of the right steps towards your financial goals, we welcome the opportunity to do that with you. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. You can also find us at Facebook at Money on Tap or any of the podcast venues out there, SoundCloud, Stitcher, iTunes. We appreciate you listening, and today we're going to be spending some time addressing questions from you, our audience. Our clients also have questions that they come into us regularly with and about their financial planning. And last week we got through a number of the questions and answers, but we didn't have time to get to all of them. So today is going to be part 2 of some question and answer. You've got questions, and we've hopefully got answers.
So, Ben, before we get into the show, I have a question for you. You know that phrase that says there's no such thing as a free lunch? Well, we're going to talk about that for a few minutes. Ben, tell me what that phrase means to you, no such thing as a free lunch.
Well, that's funny because our industry is so in tune with doing educational dinner seminars and so forth.
Yeah.
And, I did a lot of them. I did a lot of seminars.
You gave a lot of free lunches away.
I gave a lot of free lunches away. Yeah, no, ultimately in the idea of trying to, meet people and introduce them to some knowledge, some education, and some people really do need help. And that was the way I helped, build my business and meet a lot of new people in an area.
And having a business background, there's kind of a theory that goes around, there's no such thing as a free lunch. Basically, it's saying that whatever goods and services are provided, they must be paid for by someone, right? So someone's paying for it. There's no really free lunch out there. So in other words, you don't get something for nothing. We're going to spend some time talking about that in relation to your money. But before we actually get into that and talk about in relation to your money, I want to give you guys a little history lesson. I'm sure you guys studied some history in college. But did you guys know this, that a free lunch was a commonplace term in the USA, and actually in Britain too, from about the mid-19th century onward? It wasn't used to describe handouts of food to the poor and the hungry, though. It was actually used to attract people to come into dining establishments. So, for instance, there was this advertisement. This is in June of 1850. This is in Milwaukee. This is a Milwaukee saloon, and there was a paper called the Commercial Advertiser, and it said this: at the Crescent can be found the choicest of cigars, wines, and liqueurs. A free lunch every day at 11 o'clock will be served up. So free lunches, often cold food, but sometimes quite elaborate affairs, were provided for anyone who bought drink. So this inducement wasn't popular with the temperance lobby and was also criticized for the same reason that others in the 20th century later introduced. Now listen to this. It didn't used to be there's no such thing as a free lunch. It used to be there ain't no such thing as a free lunch. And now we've kind of corrected it over time with our grammar and all that. So it used to be there ain't no such thing as a free lunch idea to things. But so saloon customers really ended up paying for their lunch. But what the bartenders back at the time, the saloon keepers, actually what they would do is they would actually increase the price of the drinks in order to cover the lunch. So these guys were drinking away, thinking they were getting a free lunch when they really weren't because they were paying a lot higher prices. So it was kind of in this context that some of the economic theorists enter the fray, and they would say there's no such thing as a free lunch. That's kind of how it was coined. So we don't know who coined the phrase, but it certainly wasn't. There's an economist back in the Reagan era named Milton Friedman. He was most associated with the term. Now, he actually wrote a book entitled "There's No Such Thing as a Free Lunch," and he published that book back in 1975. But he never claimed to be the actual originator of that phrase. So it's kind of an interesting little historical concept there. But we do want to spend some time talking about investments, and just spend a little bit of time talking about how there's actually no free lunch when it comes to investing either. Now, we have spent a lot of time on our show talking about different types of investing that can be done. And one of the things we've often told our investors that it does actually take some time. It takes money to make money when it comes to investing. And we all want to get something as cheap as we possibly can, but when you're getting value, sometimes there are some costs associated with that. Now, there is an investment company that we use once in a while. It's called WBI Investments. It provides there's an article that we're going to go through that talks a little bit about this interesting viewpoint on passive investing and low cost indexing. And let me just say the phrase of it for you. I'm going to let Seth and Ben run with it. But it says, the phantom of low cost passive index products. There's no free lunch. So let's just talk about that a little bit.
Well, the concept that you kind of rolled out there with the no free lunch bit, I think is hilarious to still see happening. Like just the other day, we were at the grocery store and we were looking at, product X, and it's on sale, right? And the sale, like the original price, they say is like $17.50, and the sale price is now $10. Well, you go to any other store, and the regular price is like $10, and it's like, so value engineering.
Kohl's, going to Kohl's. You guys ever go to Kohl's before? And you go there and you buy $275 worth of clothing, but the real price, what you would have paid somewhere else, was $379. So you saved $100 on. It's just ridiculous. Yeah. So there's always it's a marketing's everything, I guess. So we mark it up to mark it down, basically. Price it up and mark it down. Value engineering. I love it, and it makes you feel good, right? It makes you feel like, hey, I kind of walked out of this situation, a better person for it, or well,
at least.
Exactly. Well, Ben, one of the things, Ben, that we've been seeing is that we see the mainstream press really doing a lot of talking, a lot of chattering out there about regulatory focus, about low-cost passive investing, and how that's a superior investment approach. So there's really an increased focus on that right now.
Yeah, I mean, I can't even tell you how many times I've run into people who, know what I do generally. They know I'm in the financial world. They have no clue exactly what my distinctions are.
Ben likes to keep it mysterious
for
everyone.
Mysterious.
I'm in financial services.
Yeah.
Yes.
And, but there's never a shortage of conversation around passive investing and what my thoughts are on that. And, we all have, I shouldn't just say I, but we all have, been involved in the active and the passive side pretty heavily in our careers. And it's part of every day, both pieces. And I think that, as we're trying to balance those concerns, it's not necessarily like one's right and one's wrong.
No, in fact, we use both strategies, actually.
Yeah, and I think that's where the confusion is. It's kind of like people are, taking up sides. Well,
I'm on this side.
I'm on that side. We do, I actually really like the blend. I like, there's one manager we use, and, without using names, they have an actively managed passive holdings.
Hi, my name is Seth Krussman, partner with Brayshaw Financial Group and one of the co-hosts of Money on Tap. One of the biggest concerns and largest expenses people face today is taxes. Without thoughtful planning, taxes can destroy future retirement dollars, eliminating the possibility of a timely retirement or dreams of what you want retirement to look like. If you're like most people, you're getting closer and closer to retirement, and you may be wondering if you're taking the right steps. Will my income be enough? Will rising taxes force me to give up my dreams? How does inflation factor into all of this? These are real concerns, and you're not alone. Putting a plan around your financial future is what we do. If you have questions when it comes to your financial security, And if you're looking for a personalized solution, contact us at Brayshaw Financial Group, 855-226-8551. It's time for you to start getting answers to your questions. Headquartered in Bedford, New Hampshire, Brayshaw Financial has offices across the country. We'd love the opportunity to show you how we can help. There's absolutely no cost or obligation to meet with us. Call us at 855-226-8551. 855-226-8551.
The ability to actively manage passive holdings. You literally say, listen, I might, just for example, maybe buy something that mirrors the S&P or something like that. And I want that kind of holding, but I want someone to kind of move in and out of that when it's appropriate, because I don't want
not
that.
just ride it all the way down.
Right. So they'll literally buy low cost and so forth, and they'll focus on that in the passive, but they'll throw a little tactical kind of on top of it.
By tactical, explain that.
Tactical by literally going to cash, maybe. Some managers will buy mirrored index programs.
Okay, so you're talking about a strategy that they can actually move money back and forth actively.
Right. And the active side might be that they're going from one passive holding to another passive holding. They might be buying something that mirrors the S&P and then moving to something that mirrors the Russell. Or a portion thereof. And so that's kind of one of the pieces that I think is really unique. It's not an all or nothing.
Right, and it's so common for us to try to choose sides. I mean, that's just a normal human interaction and behavior, is to hear two sides of an argument and really try to make a decision which camp we're going to be in, or have this feeling like we need to be in one camp or another, or because I want to be on the winning team is kind of the what goes behind that thinking. But that philosophy has really driven a lot of people into possibly some precarious places with some future corrections in the market.
What I'm looking at, and sorry to interrupt you, Seth, but what I'm looking at is we're 8 years now into a bull market. And that bull market has made it very popular for passive products, because as people are in passive investments and they've just kind of rode up, then it's a very easy place to be. However, when we see things starting to flip, Seth, that's one of the things that is a concern. Yeah,
so there's the passive investment philosophy is basically we're going to go ahead and participate in fund XYZ. Okay, and what that has done is it has gone out and it's tried to mirror an index typically, or some kind of blend of a basket of stocks. Say S&P 500. It's going to try to mirror 100 of the stocks. The advantage would be there is a low cost side of that, where you don't, as an investor, don't have to go out and purchase 500 separate individually weighted stock.
That would be expensive.
Percentages. Yeah. I mean, the trade fees on top of that alone is like pretty exorbitant. But then, whatever the cost of the stock is, and to get the weighting correct, which means, you have to have a certain amount of that stock to try to create or replicate that index. So that's a crazy way to try to go out and do this. So this simplifies, if somebody wants to be involved, that they can be involved in basically participating in the market, whatever the pros and the cons are of that, and at a relatively low fee. But to say that there's no fees which is kind of what has been personified by this whole low cost indexed investing, is that this is a totally low fee type of an endeavor. And to say that people aren't going to be making money is crazy. Like, that's the no free lunch. The part of this, I think, that we're trying to identify is that these are massive amounts of money. That yes, there is management and there are ways of extracting fees. It's just how much transparency in this world of transparency that we're supposed to be living in is there? And some of that is not easy to read and easy to define, but there are fees that are being assessed, and so there is money that is being made. And ultimately, I think it's like identifying that we're in an environment that we don't want people to make money. That's crazy. We want to be investing with people that are doing well and not turning upside down and rolling over in the middle of the night with a bankruptcy or Chapter 11.
Well, everyone seems to have this perspective. We've had a really good bull run market here, and everyone's very much, forgetful. I mean, essentially, like if you owned a passive holding right now, passive holdings haven't really beaten active holdings for the last 15 years. But if you go back further, there's points in times where they swing, right? So when you're looking at an advisor, when you're actually choosing somebody, I think our perspective is somewhat unique, not completely entirely. Some people swing one side or another, right? So we got active advisors, we have passive advisors.
It's always active versus. It doesn't need to be active versus.
Right. And but we buy passive holdings all the time, and we'll go out and buy straight up equities and say, listen, hold this.
Yep, 7 to 10 years.
Yeah, this is something we want you to buy, and we think it's a good hold, and and we don't get paid on it ever again, but then there's the other piece of it that's, do you want to get burned in the next 2008? Because, I truly believe we got some stuff coming down the road at some point in time where if you're not carefully finding oversight, then you're going to get burned.
You're listening to Money on Tap, and if you're looking to sit down with an advisor and start making some of the right steps towards your financial goals, we welcome the opportunity to do that with you, and you can reach us at 855-226-8551. That's 855-226-8551, or email us at info@yourmoneyontap. You can also find us at Facebook and SoundCloud and Stitcher, all of those podcast venues out there. You can have a listen to some of these past episodes. We're doing some question and answer, but before we get there, we're going through an article, which is something that we love to do because people pull out some ideas that we can work through. And the concept here is that low-cost passive investing camp is getting to a place where it's dangerously high, and people have forgotten so much of what they had to get through. I just can't tell you how many people we've worked with that we've taken a look at the 90s and then 2000. And it's like, oh yeah, you lost half your portfolio there, and then it takes how long to get back to where they were at in 2000, and then there's 2008. And it's like, what happened in that period? Well, I just wrote it out was one answer, or I had this philosophy that we were going to adjust all these things, and all those adjustments were going to take us through this never happening again. And then what happened? It happened again. Well, not every market cycle is going to be the same, right? And so I think one of the ideas that we're trying to identify here is, how do we diversify strategies and placement of monies to just not be entirely low cost at the whim of the market?
Yeah, do you want 100% of your assets all at the whim of whatever the market does? I often tell investors, I'll say, do you want to have your money totally reflective on whatever the S&P 500 is doing? You probably don't. Ben, you do a great job, and I'm just going to tell you this, when talking, well, not in most
I agree.
things,
I don't know what you're going to say, but I agree.
You do a great job of making me a free lunch today. But you do a great job of talking with clients about the aging America. And this article from WBI that we're talking through says this. It says the aging demographics in the U.S. who have the largest wealth pools, so seniors and baby boomers, are concerned because, as you were just saying, Seth, they can't afford another 50% loss like the last two bear markets have handed them. So the problem with low-cost passive indexes is not the upmarket returns. That's great. It's the symmetry in down markets that causes investors to take large losses.
Yeah, so the one thing that I think is people are missing the big point is this. You, John, and Seth each have one particular day in which you guys are both going to retire, and you have a finite, specific time period in which you're going to be retired for, right? So when you look at averages of the market, it's like if you retire and the market starts tumbling down, then your retirement years are really going to stink.
But whoa. Hold on a second.
That was
there.
fast, Ben.
I have a glide path fund. That's a target date fund that says retire in 2050. And it's supposed to self-adjust for me so that I go more into bonds, which is safer, right?
Okay, so you're being sarcastic.
I am. I'm sorry.
It's hard to turn off that sarcasm.
It's so hard.
I understand, Seth.
And forgive me for going that direction, but I mean that I think is one of the things that we just were talking about there, which is that even though that's identified as maybe a strategy that's supposed to reduce the volatility, and some people have followed that path. When 2008 happened, what happened there? There was a whole segment of the population that had gone that route, but still went into a tumble, like a free fall with the market.
Yeah, I think that's why there's a ton of upheaval in the time date funds. I mean, people are there's a lot of bouncing in and out of those things. I think ultimately, when we're looking at figuring out when you're going to retire and if you're going to have a successful retirement, see, as planners, we have one chance to do it right. And I think when it comes to being passively invested, whether you're with X big company or Y big company, you get burned. They make it very clear you're burned because you're burned. You chose the market and you're straight up. Yep. You wanted these low fees. That's what you wanted. You own it.
But that is the fee pressure out there right now. Isn't that everywhere you read now is talking about fees and talking about making sure you're not paying too much, which obviously, the buyer needs to be aware for sure.
Oh, yeah. Fees need to be fair and you need to be paying for something specific. And when you're buying just a passive form of investing, it should be inexpensive because no one's doing anything other than giving you that.
Yeah, the collecting the assets and
putting it in the account, and then you've got to basically handle it yourself, and you're stuck with the outcome yourself. And there's no accountability, right? There's no assessment for your needs, and so what ends up happening is, you're basically time stamping when you retire. You're either going to roll the dice lucky or you're going to roll it unlucky.
Yeah, you certainly don't want to roll the dice when it comes to something so important.
If you start retirement in 2007, your retirement look a lot different 24 months later.
Yeah, for sure.
And if you've, it's kind of a tragedy when you go one way or another. I think, one thing about, passive investing and WBI, I mean, they're definitely biased. This article is a biased article, right? Because they're an active manager. And they've done well. I mean, they've got some, but they make some really good points, as you had mentioned, about the demographics of America and how that's going. But I thought what was really interesting about this article, John, was in where passive investor risk increased due to liquidity trap risk.
What is that saying?
Well, what is that saying? Well, that's basically saying, hey, listen, if everyone's got their assets buried in these passive holdings, and they're so overweighted. So think about it, right? If you're on a seesaw and you got 1,000-pound gorilla on one side, and you're, Joe over on the other side at 150 pounds, you're not going to move that gorilla. And
so when the market starts shifting,
and you can't get liquidity, that thing starts tanking.
The great majority of people that we see come in when talking with their retirement, their 401ks, the great majority of people that we see have everything, just about everything, passively invested. We see so much of, we have a Dow 30 fund or an S&P 500 fund. That's the great majority of how people have their money invested.
So were the numbers here, there's the two most popular passive invested funds, there was like $7 billion in those. Is that right? Or was it closer to trying to see what the number was there?
Well, it says that it was $350 billion invested in the top two S&P 500.
That's what it was. Yeah, so $7.8 trillion are benchmarked to the S&P 500. So the thing that liquidity trap, and this was something that when this happened, I was like, wait, what are you talking about? There's been a sell-off in the market, but there weren't buyers. Well, for every time that people are selling these, there has to be another side of that that's able to pick up that purchase.
That volume, yeah.
Yeah. And so when that stops happening, when the sellers can't find buyers, that's the liquidity trap where prices are continuing to fall and there's no way to get out. Yeah, and that's where with that much money tied up with, those funds, and that's a dangerous spot to be in.
I don't think we understand really, like Ben, you just read off a stat there, about $350 billion invested in the top two S&P 500 index funds. Does anyone really have a clue of how much a billion is?
Well, it's hard for me to count all my billions, John.
It is. But they're there. But let me give you this fun fact, Seth. I don't know if you've heard this before, but how far apart is a million from a billion? So I want you to think about, we're not even talking trillion here, but this is how far apart it is. If you counted up 1 million seconds, that 1 million seconds would be 11.7 days, right? If you counted up 1 billion seconds, that would be over 31.7 years.
Years?
Years.
11 days to 31 years.
Yes. So just so that you have a clear understanding, it's hard for us to calculate. We always throw around these big numbers about a billion or a trillion, or we talk about the national debt being at $20 trillion. It's hard for us to really imagine what that is.
I wonder how many seconds is a trillion.
I don't know. I don't have time to calculate. We can get our statisticians going on that, though.
No, but that's a great point, John. I mean, I think when you start thinking about, millions and billions, it is hard for us to contemplate. So if you actually look at this and you say, not just 1 billion, we're talking about 350 billion, and just the top two.
Sure. And so what the article is saying that at some point, when the markets start tipping and we start seeing things going in a negative direction, because we have been reporting for quite a long time with our clients, things have gone well in the markets. However, when the scale starts to tip, there's going to be an ensuing rush to the exits to get out of those S&P 500 funds, whatever it may be, because people get scared. So it's going to go from great optimism to great pessimism out there. What's going to happen to
well, that's,
your funds?
as you mentioned that, right? So when you start thinking about the S&P holdings and the different stocks in there, there's really strong companies, and then there's small companies that could be strong, but may offer more risk. And people are looking at this saying, I don't want 2008. Now I'm fully retired. I need to downsize that. I want to cut that in half or in a quarter, or I want to take it all off the table, and I want to go to something conservative. And we've been talking about this. I've been talking about this for so long. The demographic movement here is going to decide where the market grows and where it tumbles. And if people don't get on board with that story, I was talking to a gentleman this weekend at my son's soccer match, and I was just saying, we were just chatting, and he's an engineer, and we were talking about math and different formulas. We had a lot to go into developing strategies around computer programs that could do tactical and active investing around that. And I said, yeah, there's a lot of companies that do that. And we were just chatting about it, but I said, but the real issue is, just like the robo-advisor, just like these, this passive income, nothing that we're looking at historically makes any sense for us when you're looking forward, thinking that a third of America is going to be retired.
It's different. Now, you said something the other day in a client appointment I thought was really insightful. You were talking about how retirees we've only had...
Wait. That's 2 compliments in a day, John.
And you're done. And
Seth, what's wrong with him? Is he ill?
I was kind of expecting a free lunch today afterwards, is what I was thinking. So I can say a couple nice things about him.
He's got another motive.
I think Ben said he's taking us off afterwards. But basically, you were saying that in our country, only 5% of the population typically has been retired.
Yeah.
And it's shifting from 5% with all these baby boomers retiring up to 38% we expect over the next 20 years.
It's never been more than 5% until now. Right? Yeah. I mean, this is the first time period in history that we've been over that 5% rating from the statistics I've seen.
10,000 people a day turning 65. All those folks retiring and looking for income.
And that number's growing. That number's growing. And what's scary is that people don't see this ensuing swing in our world. We've got all this money, this 1,000-pound gorilla on one side. We got this 150-pound man, and we're trying to move the gorilla around. And go ahead, Seth.
Just Malcolm Gladwell tipping point. If anybody's looking for, kind of some other illustrations of how this theory works out in all sorts of ways, it's fascinating, and it's very true, Ben. And it's interesting that there's kind of like this trickle down effect, and then it's like it turns into a flood.
Listen to this point. Listen to this paragraph. The concentration in passive index products points to the possibility that future bear market cycles will be faster developing, deeper, and more damaging than previous cycles. The financial crisis handed investors huge losses as virtually all asset classes sold off as investors sought to reduce risk. We believe, this is what the WBI article is saying, we believe the warning signs about liquidity risks are on the rise as seen in the 2010 flash crash, then again during the quick sell-off of risk assets in August and September of 2015, and once again in January and February of 2016. In 2010 and 2015, regulators closed markets, and in 2015 and 2016, the Fed intervened to keep the asset bubbles intact so consumer wealth effect spending would continue.
Yeah, this flash crash, it's crazy.
And that's not that long ago, right? We're not talking about ancient history here in our markets. We're talking right around the corner, 2 years ago, a year ago. I mean, that's when regulators had to step in and do something drastic, close the markets to stop the hemorrhaging and kind of prop things back up again. And, to say, well, I never saw it coming, or there was no indicator whatsoever, that is a typical investor mentality.
Exactly. And here's what we need to do as advisors. Our job is to design investment solutions for our clients that will help our investors to stay comfortably invested through both good and bad market cycles. We're going to have them. And so passive index products don't always fit that bill, and because they only look good to investors as the markets rise. But we need to make sure that we're doing a good job diversifying client assets, and we do a lot of that. We've done a lot of that over the years and done it quite successfully.
And in the managed space, we have diversified active and passive repetitively over and over and over again, because you don't know who's always going to be the winner. I mean, when you think about you think about the flash crash the night of the election of Trump. I mean, we're talking nearly 1,100 point swing, which was nothing that even happened in 2008, right? We never saw a 1,100 point swing in less than 12 hours.
Right.
So you think about that. I mean, we dropped 700 or 800 points, rebound, and then 200 plus points the next day. That's crazy.
Mind-blowing. Mind-blowing. You know what else is mind-blowing? Money on Tap, and that's where you're listening to right now.
Blows my mind, Seth, every time I listen
Blowing my mind right now. Ben and John, thank you so much. You are listening to Money on Tap, and if you're looking to sit down with an advisor, start making some of the right steps towards your financial goals, we welcome the opportunity to do that with you, and you can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. We also appreciate our radio affiliates out there that you're listening to us through today, and all the support, all the calls, all the questions, all the thank yous. We appreciate you, our audience, and our clients for listening to us. You can also find us at Facebook and at SoundCloud and any other podcast venues out there. Now, I think. Were we going to depart from the article here, Flash Crash article?
We are.
Kind of get into some real question and answers?
We are going to do that. We're going to do that right now. But before we do that, I want to mention one thing. Mm-hmm. And I like how the article is summed up. I'm going to say it in one paragraph. Folks, when it comes to your investing, there is no free lunch. Companies need to generate reasonable revenue and profit to provide products and services to investors. Everyone needs to get over the idea that business people are foolish enough to provide valuable services for nothing. If working for free seems like such a good business model to investors, media professionals, and politicians, why don't they give it a try? I thought that was just a good way to sum up what the article was talking about.
Mm-hmm. Yeah, so. No, I think that's important. When it comes to understanding these values, I'm wondering. And this is just a thought. You remember how there's a number of different big industries that have lowered their pricing so low that they're actually losing money, that they wiped out their competition.
Yeah.
And then they started raising their prices. Kind of interesting, but I'm just wondering, this fight for low fees, like how little they may be making or just breaking even or whatever just to get the volume, because they actually make most of their money. All these big, passive investment companies are all offering active managed services.
So true.
And and some of them even offer annuities. It's like, so they're like,
it's a high cost.
Right. So
typical investment.
And I agree. I mean, there's all of these things have a place for certain people in certain circumstances, but they're not, some things, they're paying the bills.
Yeah.
Right.
Well, we all have had people that have come in and talked about their low cost investment, maybe the particular fund that they have. And then when I really take some time and boil down and talk to them about, well, there are some fees that you're not seeing, there's some different things that you're not seeing, then just talk about, well, how do they build these big buildings? How does that all happen? How do they pay their employees? But also, if you're invested with a firm that is only offering low cost investing, what kind of research are these people doing for your money? And what kind of strategies are in place for when the markets go the other way? So, but we're going to get into some questions right now that we've had from some clients. And the first one, Ben, is that I want to chat with you about is a question that we had come in. We've actually had this probably multiple times. Should I draw down my savings or investments to prepay my mortgage? Now, what would your thoughts be on that if you had a client that were talking to you about that?
Well, we get this question all the time, and I would say that almost every time. For the most part, the answer is no. Don't draw down your savings.
But why not? Because you think about
cash is king, right? Yeah. I mean, everyone says that. I mean, there's some.
Dave Ramsey says that cash is king.
Does he?
Yes, he does.
I didn't even know. I've never listened to his show, but probably should. I probably should listen to it one day. But what I would say is this, is that, having the accessibility to cash, is better than trying to pay something completely off if you can't pay it completely off. You might be stuck. You might have a health event or this, that, or the other thing. I mean, sometimes having cash on hand can save you from a lot of different pieces.
Yeah, the piece that I'll go ahead and use the Dave Ramsey illustration. I've taken the class. I love what Dave Ramsey preaches, and I love the fact that he is so motivated. I mean, to the fact that there's so many people in debt that need to get out of debt, and it's a huge milestone for people to wipe out and eliminate debt. It takes a very aggressive mindset and active stance to be able to do that, and he does that very well. Now, there are instances, I think, that he's not entirely correct. I mean, he's not taking a look at the big picture. He's doing, there's a tendency to do the carte blanche answer. We just talked about this, being in one camp or the other. It's like, well, that's not what's suitable for every person at every stage of their journey. Now, if you have a mortgage that is, out there the 30-year mortgage, right, and it's at an interest rate that's over time is going to cost hundreds of thousands of dollars. It's at what point is that liquidity that we're talking about having cash available? At what point does that become a hindrance? Do you understand?
Okay, so we're talking about two different things in my mind.
Okay.
But Dave Ramsey might not be. Okay,
Yeah.
So for instance, there's the person who's in debt, meaning that they've got credit card debt, they've got bad debt across
Right.
the board, and
Sure.
then people who own a home that are building equity inside a house.
And they want to be aggressive with it and say, you know what, I want to prepay, get this out of my way.
Yeah,
Cut down on my
15-year
interest
mortgage.
rates.
Right.
Yeah.
Yeah,
Save money.
and I appreciate all of those things. So I break that out into two scenarios, because one is an investment, which you're paying a fee called interest to a bank to, acquire that investment, just like you pay a fee to any financial person to manage your money. You pay a fee. So those kind of things are different in my mind than just a straight up debt.
John Ryder gives us a better understanding about pensions on this Cliff Notes edition of Money on Tap.
Pension can be a very, very valuable thing for a retiree. Many people aren't aware, hey, if you're getting a pension for a couple $1,000s a month, do you realize how much money the actual company has to have put aside for that? It's really an incredible amount of money. But basically, a pension is simply a retirement account that an employer maintains to give you a fixed payout when you retire. So we sit down with a lot of people in our offices, and they come in and they'll tell us about their different incomes that they have coming in for retirement. It may be that they have a 401k. They may have a Social Security that they're counting on, but they also may have a pension as well. The pension typically is determined, how much pension you get by how long you have worked for your employer and what your salary was. And when you retire, you can actually choose between getting a lump sum pension or payout or a monthly annuity payment. We see a lot of people that come into our office that they're offered typically like a buyout for their pension, and they can actually either take a lump sum or they can actually get a monthly amount coming in. So many times what we are doing as advisors is helping folks to understand, hey, is it better for me to actually take a lump sum here, or is it better for me to take the monthly payout? And sometimes that lump sum can be very attractive, but sometimes you wouldn't want to trade that for that monthly income that they have the ability to have coming in. But many people really aren't aware of really how valuable those pensions are. But you think about this. If you think about a pension, you think about that monthly income that is driven every single month by that underlying sum of money, it has to be an incredible amount of money to actually generate a decent pension over time.
Find out more about three-dimensional investing, utilizing insurance, brokerage, and fee-based planning with Ben Brayshaw, Seth Krussman, and John Ryder on their weekly radio program, Money on Tap.
So I think there's some tools that get forgotten sometimes in this equation, and there's some ways to do this, I think, that are cautionary ways to pay the mortgage and still retain your liquidity. Right? The thing that we don't want to have happen is your life, very common is there's a disabling and category type of a situation where there's in-home care, there's all these medical expenses, and guess what? There hasn't been disability insurance, or there hasn't been proper insurance and safety nets established for those kind of scenarios, and now where is the money going to come from? Well, it's usually going to come from property, home, whatever savings there is. So how do you protect against that happening? Insurance would be a great place to start, making sure that there's some safety nets there. But if you're going to go into a prepay your mortgage, go into it with the mindset that I want to have access to my capital that's in that house if I need it. And so the home equity line of credit, I think, is one of the best, one of the lowest cost ways that people can just retain access to that liquidity, if that is in truth what we're trying to maintain.
Yeah, no, I think that's definitely a viable scenario. I always tell people, I put extra money down. I pay a little bit more on my mortgage every month. I just kind of was taught that, and that's just something I do. And I try to make an extra payment a year. And, those are the types of good practices you do. I think when it comes really down to drawing down your savings or your investments to prepay your mortgage, I get that from people going into retirement. Like
they're concerned about that big mortgage payment out there.
Right. They're saying, well, I haven't finished paying off my house. Should I just pay that off and this, that, and the other thing? And it's like sometimes the answer is yes.
Right.
But invariably, I find that people don't have enough in the way to, offset. Like if they pay off their mortgage, it doesn't really solve it's not a direct wash with the amount of income you can create versus the expense that you're getting rid of. And that's the balance.
If it's a drop in the bucket, if it's like going out and paying the balance on your credit card, if that's the question that you have right now, and there's two kind of, if you're taking away from a massive chunk of your savings to pay off your house, probably not the best thing to do. Because
that's because there's an opportunity cost there. So that opportunity cost, if you're paying off your mortgage, let's say it's $100,000, you have the $100,000 available. But if your $100,000 is in the market and is doing well, and it may not make sense if you have a very low interest rate. However, if you have a real high interest rate on your mortgage, well, maybe it would make sense to pay that off.
Okay, let me give you an example. Let's say you have an annuity creating some income for you.
Yep.
Okay, and let's say your mortgage is $1,200 a month,
mm-hmm.
but that annuity is creating $1,500 a month in income for you. It doesn't make sense to liquidate the annuity to get rid of the $1,200 payment and lose the $1,500 income.
Sure.
Correct.
Right? And that's sometimes the scenario that occurs.
There are trade-offs.
Yeah, there are trade-offs.
Yeah.
So, but at the same time, if an annuity was paying you, $800 a month and you had a $1,200 a month mortgage payment because of the shorter time period that you had to pay it in, that's usually what happens, right? It's either a lower number because you spread it out over a longer period of time, or it's a higher number because you have a shorter time period payment. Well, if the payment's $1,200 and you're getting $800 of income, but you could pay it off by liquidating it, well, that's a $400 a month savings. And I think you have to evaluate some of those pieces. So to say that there's one right answer, but most of the time I find that just having the asset on hand. The second thing about a mortgage that a lot of people don't give any value to, but have found more value recently, is the fact that the bank owns a lot of liability inside a mortgage. Right? I mean, how many times have we heard about people who have, had to do short sales on their homes
mm-hmm.
because they were in an area or neighborhood that was completely devalued? I mean, there's whole neighborhoods that are completely vacated where people were going in and, stealing the copper out of the walls and stuff.
Sure.
I heard, what was it, Ohio or Pennsylvania or something like that?
Yeah, all over.
Yeah, and so, but by having the bank own a portion of that liability, that's part of what you're paying them for with interest. And so there's some value inside some of that stuff that we don't really take credit for. So if you had a $300,000 home, you put your 20% down and your mortgage was $240 and you said, hey, I paid it down to $200 now. Should I take $200 out of my asset and put it into the house? And then all of a sudden the real estate marketplace goes haywire again and your house is worth $200. Well, then you just lost another $100,000.
So if you retain the cash, you actually retain the control. Not that you can't pay that off later on if you want to,
right.
But the fact is that you have that cash that's available, or your investment that's available, you can actually take that money and pay it off at a future time. And so you retain the control. So that's a lot of times the answer we'd have for someone that would be asking about that.
And I think there's no right answer. I think there's a specific one for everybody.
But if you can go ahead and you have the opportunity to prepay in certain situations, it may make a lot of sense for you to do that, just to cut down interest payments. And there's calculations you can do to help you figure that out.
We got one more question here.
Only one more? I
got another one here, I guess I'm saying. We got some more here. Should I have life insurance, John?
Well, Ben, if it's you asking the question, you should have more life insurance than you can afford, Ben. You probably need a lot more than you can afford.
I'm trying to get rid of life insurance so no one wants to off me.
But you know what? That's a question that we have oftentimes. And people will also assume, well, I probably should have it. But you know what? We find a lot of people that actually don't have any life insurance at all. And here's my answer. If someone asks me, should I have life insurance, John? Here's my answer. If nobody's depending on you, you're single, you don't have any dependents, you don't need a whole lot of life insurance. Life insurance is really for the purpose of replacing your income. If you're the breadwinner in your family, then yeah, you need life insurance, somewhere maybe around 5-10 times your income. Who knows exactly? We need to actually sit down and have a needs analysis to determine exactly how much you need. Sometimes people will throw that number 5 to 10 times out your income. It really depends upon your situation. You could be a doctor that just graduated from med school. You're in your first year of practice. You could have close to $1 million of liability as far as your debts. We've seen that before.
Yeah.
And they have a huge amount of debt out there that if they were to pass away, it would really handicap their spouse or their significant other or kids, that type of thing. So it really, really depends. You could have other people that graduate college, they have zero debt. So they wouldn't need to have any insurance to cover that. So it really, really depends upon what your personal situation is. And so when we're talking to people about life insurance, we're going to ask
all
them,
about evaluating loss.
Will
you have a loss that needs to be replaced upon your death?
What kind of risk do you want to assume? There's many people out there that even though they do have a lot of different liabilities out there, they have a family to support, they have not gotten insurance in place. They often talk, well, I have some insurance. This is a common, Seth, you get this. I have some insurance at work. So I think it's, and if you ask them how much, well, I think it's 1 or 2 times my salary. That's really a discussion you want to have with someone before they pass away as opposed to with their spouse.
Well,
since
you brought up the work insurance, this is the one thing that I always tell people about work insurance.
Yeah.
When you're no longer working there, you no longer have it.
Yeah.
And then you have to go out and get your own insurance. So I always tell people, I say, work insurance is good. Consider it the added extra. Consider it the little bonus if something happens to you, because insuring your insurability, this is something I was taught by a gentleman who was in the life insurance world forever. And he said to me, and I didn't really take a lot of value from it when I first heard it, but, having been in the business as long as I have now and seeing people really have health and life events that need coverage and seeing people who didn't have enough. Ensuring your insurability is really important so that if you lose that job, you may go to another job that doesn't offer insurance. You may not have coverage. Or what happens if you die in between those jobs? And so making sure that your core insurance piece is in place and that is a little bit of a bonus, even though it might be a little cheaper getting it through work.
Sure.
And if that's all you can afford and do, that's great. But it might be something to consider of how do I insure this and ensure my insurability.
Let me chat with you two guys about this as well. There's a lot of misconceptions that people have when it comes to their group insurance through work. So, and I know you guys know this, but if you have a group work life insurance policy and you're not paying the premiums on it, let's say that you're doing very well and you're making $100,000 a year and you have a group policy through your work. If your employer is paying for your premiums, then that is a taxable event. So when you pass away, that $100,000 policy that you have through work is not necessarily worth $100,000. It's worth whatever your tax bracket is less than that. So if it forces you, that $100,000 forces you into another tax bracket. So if you go from $100,000 to $200,000 of income, then that's a taxable liability to you. So you may only be getting maybe $75,000 to $80,000 after you pay taxes on it. If it's a policy that you own on your life that you pay for each and every month through a premium, ACH deduction, whatever it may be, then that is a tax-free benefit. But there's a huge difference between a work policy and a private policy. Depends upon who's paying the premium.
Right. No, good point. Good point.
Well,
we got another question here. No one ever asked this one. I'm actually shocked this is on the list, John. How much money do I need to have saved in order to retire?
Oh, I've never heard that before.
Never heard that question before in my life.
Yeah, this question, Seth, this one has a lot of variables.
We should just breeze right through this.
Yeah.
You can have $1 million. Okay, we're done.
Yeah, right. Right. That's the solution. That's the number. There's a number, right?
ING or Voya did a great job on this story, right?
Yep. Yeah. What's your number?
What's your number, Ben?
What's your number?
Guy sitting on the bench, a little number clicking over his head.
Uh-huh.
I thought that was a really interesting thing. It really gets, so they're attracting people to put money away, right? Because they want more and more money invested. Mm-hmm. So they're saying, hey, everyone wants to save. Yeah, you need to move that number up. Save, grow. And that clearly is a major focus. Mm-hmm. But the question you really need to be asking yourself if you're sitting listening to this today is, what's your income number? Because at the end of the day,
I mean, how much income are you going to have coming in from different
yeah,
places? Yeah.
how much income do you need when you retire?
Or what's your expenses?
Right, because let's say you had $1 million. If you had $1 million and you get 1% income,
yeah,
that's a lot different than 5% income.
Yeah.
Right? So how much income are you going to generate from that? So if you need $50,000 at 5%, well, hey, $1 million is fine.
This is why it's so important. Okay, so these basketball players, you always hear about this, and we've talked about this on the show before. We have a basketball player, a football player, that's been making millions of dollars for years, doing very, 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 very well. And then all of a sudden they stop playing, because these guys all have short careers. It's just how it works. Yeah. They stop, but then they don't stop their spending, right? So they may have been making millions and millions of dollars, and maybe they have lots of investments out there, but the fact is their retirement lifestyle doesn't stop. So their expenses are crazy too. But that's why it's so important, the stuff you were mentioning. Let's know exactly what our expenses are going to retirement. It's exactly as we can know. Obviously, that it may be a while out for many of our listeners, but it's very good to help project those.
And that's where our client portal has really helped us a lot with a lot of people who can't do that.
Yeah, some of the hardest ones to really try to grasp or understand are the taxes, future taxes. What are those going to be looking like potentially? And sure. And also the medical expenses. Like that is a huge growing number, in one that just so many people get blindsided by, like, oh my gosh, I don't have a company medical plan that I'm a part of now, and I'm expected to be paying for these all out of my pocket. I did not plan for that. Or, but a lot of the other ones are kind of typical, your house payment if you have one of those, or, whatever those typical bills and just regular things that we can kind of plan through. We can usually get through that. And then once you have your number of what you were saying, like what's your income number you need, then we can usually kind of reverse engineer through that process of what is that number and where would be the best place to be trying to create that income through. What are some of the options that we have? Are you in a entirely taxable at ordinary income tax distribution type of an account, which would be qualified account, your 401k or IRA or anything like that would be taxed at an ordinary income, so we can understand that number pretty well. But then, have you done any type of saving outside of that, a non-qualified? Is there real estate income? Is there schedules of depreciation that we can start to take a look at, maybe moving some different real estate into other real estate programs that might have options like that to create more tax advantageous types of distribution methods?
Wow, Seth, that was a mouthful.
Yeah, no, it's true.
But a lot of good points there about that. Having tax-free income in retirement is huge.
Yeah. Well, I think that's even bigger. I mean, it's so much bigger than we realize. We talk about that kind of off the cuff, but the truth is that I think 15, 20 years from now, it's going to be the mainstay, because what people don't realize about tax-free income is how much taxes it saves you on your taxable income.
Say that again.
Yeah, I'm going to say it again. So the tax-free income, how much taxes it saves on your taxable income. And the reason I say that is because if you're pulling out $100,000 of income, right, and $50,000 of it is from a Roth IRA, then your income is only going to be taxed on the $50,000 from your IRA.
A lot better than 100%. And
right.
We talked
different
so much
tax
about this
brackets,
before.
different all that stuff. So you're still getting your income. So focusing on that. So a lot of people don't equate the long-term value of what it's going to do for other dollars. And that's something we're always trying to help people see. That's the three-dimensional investing piece that we talk about, is understanding how they all kind of lock and key fit, and
sure.
to reduce long-term expenses. So, well, we got another question here, and we're going to wrap up with this one here. I'm getting ready to retire. Should I invest a lump sum of money into an annuity? If so, what type should I consider? Well, that's a big one.
Yeah. And next show will be.
Oh gosh, wow! That's a big question, right? I mean, there's just so many. There's literally probably millions of types of annuities, with millions of types of benefits. Some are fixed and some are what we call variable, which are market-based. And I think when it comes down to it, you shouldn't put all your money anywhere.
I guess my answer would be maybe. And it really depends upon what your situation is. I guess the only way that you can find the correct answer to that question is by doing a thorough analysis of what your options are.
And your risk tolerance.
Your risk tolerance, what retirement assets you have to work with. Sometimes it makes zero sense for folks to go into an annuity. They might not have enough assets to do that. It just may not be the right structure for them. Sometimes it makes a lot of sense because it can give them money that they can't outlive. It allows them to have money for the rest of their life if the situation works out right.
Good point. I think when it comes down to, we do so much of so many different types of investments. I was talking to a woman the other day, and she does not like the market. She doesn't like the ups and downs. Doesn't matter how much money she makes over time. None of that stuff matters. It's just she doesn't like the market. And so I said to her, maybe it would just be easier for you now that you're fully in retirement, because she had always been in the market, said that's what she wanted.
Yeah.
I said maybe it'd just be easier for you to have a portion of your money in an annuity.
That gives her some guarantees.
Give you some kind of rest assured, peace of mind kind of stuff, if that's really what you want, and then we can evaluate what kind that might look like.
Hey, peace of mind is a very, very important part of a portfolio. That's for sure.
A lot of people don't want to go into retirement and be a financial planner. So that's one of those things. So.
Well, we appreciate all the questions, and hopefully some of the answers have helped you to maybe understand your situation a little better. You've been listening to Money on Tap, and if you're looking to sit down with an advisor and start making some of the right steps towards your financial goals, we welcome the opportunity to do that with you. You can reach us at 855-226-8551 or email us at info@yourmoneyontap.com. Also, you can find us at Facebook at Money on Tap. We appreciate the likes. We appreciate the listens and all the downloads. And thanks again, you guys. It was timely and really interesting topics that we moved through. And again, hope you have a great week.
Absolutely.
Great. Thanks, everybody.
The views expressed are not necessarily the opinion of this radio station and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. No strategy, product, material, or tool mentioned can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information, products, materials, or tools mentioned should be relied upon when coordinated with individual professional advice. Past performance is not a guarantee of future results. This show may be subsidized in whole or in part by a product sponsor or issuer. Securities and advisory services offered through SagePoint Financial Incorporated, member FINRA SIPC, and a registered investment advisor. All other services offered through Brayshaw Financial Group LLC are independent of SagePoint Financial. SagePoint Financial and Brayshaw Financial Group do not provide tax or legal advice. Main office is located at 116 South River Road, Bedford, New Hampshire, 03110, and can be reached at toll-free 855-226-8551.